everybody, welcome to video 2 of the Pines and Trent Storage Complex. This video is about the 318 unit storage acquisition that we recently made. In this video I want to get into how I structured the deal and how it came to be. In the last video I mentioned that the seller reached out to me knowing that I'm a buyer in town for multi-unit facilities. Typically you guys know me as an apartment buyer, but I do also buy storage facilities as well as mobile home parks. So in this case the seller called me, and so the way I structured the deal is I brought in other investors, and I have a couple of different ways that I do the real estate investment when I work with other investors, and that's what I want to talk to you guys a little bit about in this video so you too can learn how to structure these types of deals. One way I do is what I call a fixed return investment, where I work with a private investor and just pay them a fixed rate of return. So no matter if it's leased, not leased, there's expenditure, they get the same type of return every single month. And it's a great cash flow investment for these real estate investors that are getting involved in these. In those circumstances though, because they get a check every single month no matter what, they typically don't participate in the equity. This deal was a little bit different, where I brought in some real estate investment friends of mine, and we all bought this as owners, so they do participate in the equity. Some may call this a syndication, and in this short video I'm not going to get into the different layers of structure. But in future videos I will. So if you're interested in different layers of syndication structures, or maybe a fund, if you've thought about creating a real estate investment fund, then click the subscribe button, because I'll have future videos that dive into that. So regarding this facility, we came in and I put it in an LLC. In fact, there's two LLCs. There's an LLC that was funded, okay? And then there's a separate LLC that holds the asset. You typically want to have those things separate. So when you buy a apartment building or a large storage facility like this, you want a separate LLC that actually owns the storage facility. This is for liability purposes, and it's also really clean for insurance and bookkeeping. For example, this LLC has its own insurance policy. So if somebody slips and breaks their neck, hopefully not the case, but hypothetically, if somebody gets hurt or sues us or something like that at this facility, it doesn't affect any of my other buildings. Same difference. If somebody slips and falls on stairs at one of my apartment buildings, it's not going to affect the insurance policy here at this building. And then of course the next layer of protection is the LLC itself that actually holds title to it. So the LLC that holds title has one member, and that member is the LLC that we all put the money into. And that LLC that we all put the money into is the sole member of the LLC that holds the asset. So you may need to rewatch this video if you're not familiar with that, but that's a pretty good structuring on how we put this together. Also in the last video I mentioned that when we purchased this, it was about a 25% occupancy rate, but it was at that break-even point. So we've done some fantastic things to get this off the ground, like building a new website where you could rent online. That didn't exist before. A 24/7 call center, so you could always get your questions answered and be brought to the online source to rent. That also didn't exist. So those are a couple key examples. Another one is they were very limited in their hours here. So we expanded those hours with staff that we already had that worked at our property management company. And so that's an economies of scale that we were able to produce with this facility here. So I'm very excited since we've increased the occupancy about 12% in just a short few months. So I'm really excited about that and looking forward to the next 12 months or so, where I think we'll push it closer to a 70% occupancy level, and that, my friends, is cash flow. So in getting together with the seller on this, it was really important to listen to what the seller needs were. When I structure a deal, that's always the number one thing. It's not a one size fits all. I'm not a we buy cash now, close next week type thing. When you deal with the commercial space, these are typically not super motivated sellers, right? These are often savvy sellers, sellers that are not fighting to pay the bills. So you really need to be a problem solver for them. By listening to what the seller needed, I was able to customize the offer for him. Once I had the offer under contract, I put together a promotion, some would call it a pitch deck, if you will, and that's what I used to entice my investment friends that came into this investment with me. I had a bio on myself and my experience, which is important. Let me make a quick side note. And you really need to make sure you follow SEC law and that you talk with your SEC attorney when you're raising private funds. I don't know if you know this or not, but it's actually illegal to just go out onto the street corner and start shouting for investors and raising funds. So make sure you talk to your securities attorney. All right, back to the good stuff. So once I put my presentation together, it had the bio on myself, it had all of the amenities of the facility, and then of course it had the return on investment, the big one. Because what investors are looking for first and foremost, it's not returns, it's safety. It's safety for their money and safety for their investment. So when you're structuring the deal, make sure your investors are safe and they're covered. And then after that, we're talking about returns. So I was able to show them the projected returns from a cash-on-cash basis as well as an annualized return on investment. Now, an annualized return on investment is all the cash flow plus the net equity divided by the amount of years or the term that you're projecting. So in this scenario, it was a 5-year return projection. That's normally what I base mine off. So all the cash flow over 5 years, plus the net equity at disposition, if we hypothetically sold or refinanced at 5 years, divided by 5, because that's the term of the hold, and that is the annualized return on investment. And that's a great one to use for your investors because they can compare it to, say, what they might get in the stock market or other real estate investments. So we put that all together, and it didn't take long before everybody was on board. So in our next video, we're going to dive into the numbers. So I'm going to literally show you guys on a whiteboard how I structured the numbers and what the returns are. So if you guys are interested in the numbers on this facility, click the like button, click the subscribe button, and it'll notify you as soon as this next video gets up and future videos that have to do with investment and raising private capital. So until next time, to freedom through cash flow.